Financial planning is used to determine if and how individuals can reach their life goals by managing financial resources. We recommend a 5-step system. First, determine your goals and needs. Second, prioritize your findings from step 1. Third, create your own personal financial statements. Fourth, analyze your personal financial statements and evaluate how you can bring your financial priorities to reality. Lastly, monitor your personal financial statements. To help you understand what needs you may have, we have broken financial planning into several categories: personal financial statements, education planning, insurance planning, investment planning, income tax planning, retirement planning, and estate planning. In other videos, we do our best to make reviewing each of these topics simple for you to determine what is relevant for you. Personal financial statements are generally used to illustrate financial health by listing valuable property, called assets, financial obligations, called liabilities, and net worth on a personal balance sheet, while income and expenses are on a personal cash flow statement. Once you create those statements, problems can be diagnosed using several mathematical formulae, such as the current ratio, which determines feasibility to pay debts over the next 12 months. Additionally, these statements are of great help if you want to determine a budget. Education planning is relevant to individuals who will pay for their own education or someone else's. Rather than waiting until school begins to accumulate sufficient cash, you can take advantage of many opportunities in place to help you save for education over extended periods of time. By accumulating a reservoir of money to pay for education, the burden of educational expenses can be reduced immensely. Insurance planning encompasses determining what risks exist and preparing for them as best you can. Once you determine what risks need to be addressed, you can determine which insurance policy will be the best fit. Be careful to do your own research rather than simply following an insurance salesperson's advice. In many cases, your incentives are not necessarily aligned with theirs. Investment planning can help you grow your net worth and even provide an additional source of income. Take into account different investment options, how to decrease the risk of a loss, and how to create a portfolio that best fits your interests. Whether or not you have an interest in managing your own investments, understanding how investments work is always helpful. For those who have zero interest in investing their own money, you have a few options, including hiring a manager to invest for you. Income tax planning is used to lower your taxes by using tax credits and deductions. Understanding where you can save on taxes can be significantly beneficial. Individuals willing to put time into tax planning can save the cost of a tax advisor and potentially significantly reduce their tax bill. Retirement planning entails determining at what age you'll retire and how to meet that goal. To reach your goal, you should begin planning far in advance. The earlier you begin putting away and the more you do put away for retirement, the better prepared you'll be. Remember, when you retire, in most cases you will not have any income. Also, it is very important to take steps to avoid falling into the trap of outliving your money. Estate planning helps you pass on your assets to others, whether it be your family, friends, or charity. This process entails determining who will receive your assets and bequeathing them in a tax-efficient manner. Each of these planning processes should receive your attention as you perform financial planning, because the time that you invest in an effective financial plan will likely save you money and time later on.